let's get into it. So the lesson outcomes for today is that we're going to be looking at what is a company, why a company issues shares, how they buy back shares, dividends, income tax, audit fees, directors fees, right? So in between these subtopics, we're going to be looking at worked examples, right? So in between each topic or each subtopic, I'm going to be doing a worked example with you. And then right in the end, we're going to do an exam type question, and I'll show you how to approach an exam type question, right? Okay. So now, just quickly, let's look at what we had covered in the previous grades, right? So with me explaining this, I want you to understand why we do different things in different grades, right? So in grade 10, right? In grade 10, we covered in accounting something called a sole proprietor, right? In grade 11, if you still remember, which you should because we right at the beginning of the year, we covered a partnership. Then in grade 12, we are now going to look at what? We're now going to look at companies, right? So why am I talking about this? I'm talking about this because the different types of businesses that we cover in different grades affect how we prepare our income statements and balance sheet, right? Because with the type of business that you are dealing with, there are different accounts for each and every type of business. So for a sole proprietor, there will be certain accounts that will affect your income statement that are different from a partnership. So if you remember correctly, in a partnership, we had accounts such as like your current account, your drawings, bonuses, all of that, right, for partnerships. But in a sole proprietor, you don't have those accounts because it's not a partnership. Those accounts are specific to a partnership. The same way in grade 12, because now we are dealing with companies, there will be certain accounts that will be there, right? Such as your ordinary share capital, your retained income, your dividends, your auditor's fees, your director's fees. Those are the accounts that are going to appear in the statements of a company, but they will never appear in the statement of a partnership because a company and a partnership are different and those accounts are specific to a company. So the minute you understand the theory behind accounting, it becomes simpler to understand the numbers, right? So with companies, this is what we're going to be dealing with, right? This year, we're going to be dealing with companies, right? And with companies, there's going to be different types of accounts that will be shown on our income statement, balance sheet, and then also our cash flow, right? Okay, so now let's go into the introduction of companies, right? So firstly, I want you to understand that a company, what does a company do? So there's a company, right? A company needs to, for you to start up your company, what do you need to do? You either need to go and take out a loan, or you can what? You can issue shares. So now, taking out a loan is simple, right? But what is issuing shares? Issuing shares is selling shares. That's what issuing shares is. A company sells shares to the public, and then, so to the public, right? And then when they sell these shares to the public, those people that buy the shares become what? They become shareholders of the company. And what are shareholders? Shareholders are what? Owners of this company, right? So when you are a shareholder of a company, it means that you own certain amount of shares in the company, right? You own a certain amount of shares in the company. And what do these shares do for you? You have voting rights. So it means that you have the ability to take certain decisions in the company, right? And remember that it's up until a certain extent, which depends on how much you own. So a person that owns 50% and a person that owns 10%, obviously the one that owns 50% is the one that has more voting power, right? So when you're owner of a company, you have voting rights, right? And then, okay, you have voting rights, but what do you get in return for buying these shares? So in return for buying these shares, the company will pay you kind of like a salary, but it's not a salary, it has a name, and that name is called what? Dividends, right? This is what the company pays its shareholders at the end of the year. So after the company has determined, okay, this is how much profit we've made, this is how much we have decided to pay our shareholders. So sometimes the company is forced to pay dividends, and sometimes they decide. So it can be a decision that they just make, that okay, in this year we have surplus profits, so let's just give our shareholders dividends, right? Okay, then obviously one of the benefits is that you as a shareholder, you'd want to buy shares in a company that pays more dividends, right? But it can also be a downside, but let's not go there, right? Okay, so the shareholder gets dividends from the company, right? Okay, then another thing that we need to understand is that this company, right, remember that this company, they issue shares to the public. What else do? They prepare, like I said in my previous slide, they prepare statements. So they prepare financial statements. So this company will prepare the income statement, they'll prepare the balance sheet. In grade 12 accounting, it's the balance sheet, yes. And they'll prepare the cash flow statement, of which you're still gonna do a later on in the year, right? So these are the statements that the company prepares. Like we've already known in previous grades, we always prepare the income statement, balance sheet, and the cash flow statement is now a new statement, right? Okay, so now what we need to understand is that what are these statements used for, or who uses these statements? So the people that use these statements, it's stakeholders, right? Stakeholders. Who are stakeholders? Stakeholders are your shareholders, number one, because they want to see. Remember, what do these statements? These statements do? They show you how well the business is performing, right? So as a shareholder, obviously you'd want to see how well is this business performing. Will they be able to pay me dividends and all of that, right? So also banks look at the financial statements, right? Also prospective investors. Prospective investors also look at these statements. Then anyone else, right, that would find these statements useful, they look at the statements and they see how well the business is performing. Remember, if you look at the income statement, you see how well is the business managing its expenses and incomes. And then if you look at the balance sheet, you look at things like how much assets does the business have, how much liabilities do they have. If they have high liabilities, obviously maybe as a bank you wouldn't give them a loan because they already have high liabilities, so it means that they won't be able to pay you back. So this is how some of these stakeholders will use these financial statements that are prepared by the company. But then how do these stakeholders trust these financial statements that have been prepared by the company? Because it could be easy. Remember, the company always wants to look good, right? It can be easy for the company to just prepare financial statements that look good and then present it to the public so that more people can invest and then they can get loans from the bank and all of that. So how do we trust the financial statements of a company? This is where the role of the auditor comes in, right? The auditor. So who is the auditor? The auditor is the person that looks at the financial statements, makes sure that everything that's in that financial statement is reliable, it's true, it's not falsified, and then make sure that it is the financial statements are prepared according to the relevant accounting standards that we have, right? So to make it simple, remember those GAAP principles that you learned in grade 10, like your prudence, your materiality, all of that. The auditor makes sure that these statements are prepared according to those GAAP principles, in simple terms, right? And they make sure that whatever amount is on the statement, it's true. Because a company could now say they have assets worth R1,000,000, but in actual fact they don't. They just want the statement to look good so that you can invest in the company, right? So what the auditor does is that they look at that amount and then they go and check, do we actually have vehicles that are worth R1,000,000 in this company? So they go and check in person to see, show us where are those vehicles and let's value them and see if they are actually worth 1 million. So that's where the auditor comes in, right? And then what does the auditor get in return for doing this? What the auditor gets in return for doing this is that they get paid what? Audit fees, right? That's what the company pays. They pay the auditor audit fees for them to come and audit the statements of the company, right? And then remember, if a company doesn't have audited financial statements, don't trust them, right? Well, not don't trust them, but it will be hard to trust them. Okay. Then that's audit fees, right? But then remember, let's go back to our shareholders, right? We said shareholders are the owners, right? They are the owners of the business, right? Or of the company. But then, yes, they are the owners, but they don't run the company. Who runs the company? We have people that are called directors that run the company, right? Directors are what? People that run the company on behalf of the shareholders. So it means that the what's this, the shareholders are the ones that appoint the directors, right? It's the same way where you have a business but you're too lazy to do the work for yourself, so you hire people. So those shareholders will appoint the directors, and the directors will run the company on behalf of them. So the directors report to the shareholders, right? And then we have two types of directors. We have non-executive, so I should have started with executive, and then we have executive directors, right? So executive directors are the ones that are involved in the day-to-day running of the company, and then non-executive, they're not really that involved, but they are there just for control, right? Okay. Then what do the directors get in return for running the business on behalf of the shareholders? They get paid what? Directors fees, right? Then sometimes the company can decide that yes, we issued shares. Now let's go back to this point where we were issuing shares, right? Let's go back there. We issue shares, we sell shares to the public, right? What does this mean? We sell shares and we get money, right? So we sold those shares. But sometimes certain things can come up that can force the company to buy back the shares, right? And why would a company now want to go and buy back the shares that they had previously sold? This is because of things like a shareholder dying, right? Doesn't make sense for us to have a shareholder that is dead, because they not, well, when a person has passed on, they can't contribute to the company. Remember, shareholders need to make decisions and all of that. So when they are no longer there, it's a waste of shares to have shares held by a deceased person, right? So what does the company do? They buy back those shares. Another thing could be a disqualified shareholder. What does disqualified mean? Sometimes a shareholder could be involved in things such as fraud. Do you think the business would be, or they could be convicted for a certain crime? Do you think the company would want to be associated with that type of person? No, they wouldn't want to be associated with them, because they're bringing bad reputation into the company, right? So what does the company do? They say, bring back our shares and we'll pay you an amount of money for you to bring back our shares so that you are no longer part of our company, right? And other things, right, which you would have learned in your theory booklets, that there's different reasons. Or, and then the last thing would be a debt equity ratio, right? So remember, the company can either be financed through debt, which is taking out a loan, or through equity, which is issuing shares. So the debt equity ratio is showing you how much of debt or equity is the company financed by. So when the company wants to kind of like adjust their debt equity ratio for it to be more debt than equity, what they do is they buy back the shares, right? Okay, and this can be for different reasons. So this was a brief introduction, and then the last thing that I need to say is that a company, because it's a separate legal entity, right, because it's a separate legal entity, which means that legally it's its own person, what do they have to do? They need to pay income tax, right? And income tax is the amount that we pay to SARS so that SARS can provide us with services, right? Like your roads, they can build schools and all of it's how the government makes money. They collect tax from us. And this is calculated on the percentage of profits that the company makes. So this was an introduction to companies. And when you understand the theory behind the numbers, when you understand what we're actually doing, what is an issuing of shares, what is buying back, why do we buy back, who are the directors, what do they get, who are the shareholders, what do they get, who is the auditor, what does the auditor get, you will understand the calculations much more easily. So in the next video, we'll go into the issuing of shares.